Taxes are through the roof. We needed some sort of reform to the previous condo bill that came in.
We're still seeing affordability as an issue.
One of our biggest items that we push is down payment assistance for condos. Insurance is a huge issue down here. Until we bring in more carriers, insurance is not going to go down. One of the main things that anyone can do, be aware of the programs that are available. Florida is geo-targeted and is the only state that has a higher down payment requirement for condos. We feel that this is unfair, and we've done significant advocacy to change that.
Hi everyone, Serena Diaco here, and welcome back to the Digest by A&D Mortgage, your trusted source for insights into the mortgage industry. We often talk about rates, programs, and processes, but at the heart of it all are real people and families who just want a place to call home. Today, we're diving into the topic of affordable home ownership and how brokers can truly make a difference. My guest today is Orlando Diaz, president of the FAMP Miami chapter, someone who not only knows this business inside and out, but also actively advocates for housing affordability and other things. We'll explore the real challenges buyers face, what brokers can do to help, and how policy trends are shaping the future of homeownership access. And as always, we've been reading your comments and your feedback. Keep sharing your stories and questions because they drive these conversations forward. Hi, Orlando. Thank you so much for being here today.
Thank you for having me.
Of course. So you have been in the mortgage industry for a very long time, and you serve now as president of the Florida Association Mortgage Professionals. Can you give us maybe a little overview of some things that FAMP tackles, takes care of, and how they help the community?
Yes, I'm currently the state president of the Florida Association Mortgage Professionals. We are this year our 65th year, so we're a 65-year-old association, and we represent over 55,000 licensed originators in the state of Florida. Our main issues is three-way. It's to advocate for our industry, educate our industry, and network for our industry. And that's really the basis of what we do statewide.
And we see recently that FAMP has been on the legislative front. Can you give us some examples of some recent bills and some action that has been going on in Tallahassee for us?
Yeah, one of our three tenets is obviously advocacy. So it's what I personally spend a lot of time on. One of the biggest issues and that we've been tackling has been the condo reform bill that just recently passed. We were a stakeholder in that bill. We were privy to all the different iterations of that bill prior to, and we were able to put our input into it. We felt that we needed some sort of reform to the previous condo bill that came in, needed to give these associations a little bit more time, because what ended up happening is a lot of assessments were given that were for this deferred maintenance, that it was just too cumbersome for the actual unit owners, and many of them elderly, and many of them on fixed income. And at that point, because of these huge assessments, they couldn't sell their condos. So this condo reform bill was a relief for them, and we advocated that, and we felt that this was a big success, not only for FAMP but for our customers.
And so we're still seeing affordability as an issue, even with programs like FHA, VA, and down payment assistance. Do you see any, I guess, major red flags on why this is still an issue?
Well, we're being attacked on all four fronts. As you know, a mortgage payment has principal, interest, taxes, and insurance. Principal, the house pricing is so high, in a typical suburb. And, my suburb where I live, the houses, 5-7 years ago were in the $300,000-$400,000 range. Now they're in the $700,000 to $800,000 range. When you tackle that with a 7% rate, you have a $7,000-$8,000 mortgage payment. Not everybody can afford. That's a huge issue. Interest rates, they've been hovering now in the mid to high sixes, but they were in the 7s and 8s not too long ago. Unless the interest rates go down, there's really not much that we can do there. The Taxes are through the roof right now. There's some talk in the legislature about some sort of reforms for taxes, and that's something that us as an association that we're pushing for. We think at least 4 primary homes. For second homes and investments, I think that most people would trade off a higher taxes on second homes and investment for lower taxes on their primary. And then insurance is a huge issue down here. Until we bring in more carriers, insurance is not going to go down. And now as we're approaching hurricane season, we just hope that we have 2 or 3 years of not too much damage that would increase the premiums. So we're hoping we have less hurricanes, and hopefully that will affect the insurances. But we're being attacked on all 4 fronts, and it's limited on what we can do. But a lot of those stuffs are outside of our purview. But we're the one thing that we are hoping is that at least the interest rates go down.
Do you have any advice on how our partners, brokers, loan officers, even processors can get involved in affordability for their clients?
Well, I think that one of the main things that anyone can do, any loan officers, processors, anyone in the industry, is be aware of the programs that are available, not only through the GSEs, Fannie Mae and Freddie Mac, but internal programs that some lenders come out with that help with lower down payment. There's some 1% programs that are out there. Those are temporary and lender specific, but also there's programs, down payment assistance programs that are statewide. Some of them that are city and county wise. That the more you learn about those and push them, there's also issues that with closing costs that you can work on as well. Like now that the market's a little bit in flux, is becoming more of a buyer's market, you can negotiate more seller contributions on that. Knowing what those seller contributions are and those max is important. When those programs are available, communicate them as a non-QM wholesale lender like yourself. Communicate that to the broker community. I think that's important. And the more you learn about these programs, the better you're going to be. Not only the more you're going to grow in the industry, but the more you can service your client.
I recently actually saw a down payment assistance program for a foreign national investment property that they were offering in a Florida county, a little bit up north. And it was to help with 10% of the down payment, where they had to bring in 20%. I mean, no one would really know about that program unless you did the research. It was my first time seeing it, and I was like, wow, this is a very cool thing that...
And then it's also important as a wholesale lender to communicate that to your base, that those programs are available in that particular region. I think that's important. If you go to any county and any city, you'll find out that there's usually some sort of down payment assistance program. And as a loan officer, the more you know about that, the better you're going to serve your clients.
Orlando, you've been an advocate recently for, well, I don't like to say recently because you probably always have been, but an advocate for down payment reform. Any recent policy adjustments?
Yeah, one of our biggest items that we push, and it's been something that we've been working on for a little bit over a year, is down payment assistance for condo. Not actually down payment requirements for condos. If you're buying a condo, you either have a choice of doing a full review or limited review. If you go full review, you could put 3 or 5% down with the GSEs, Fannie Mae and Freddie Mac. However, if you go through a limited review, you have to put 25% down. So you go from 5% down all the way to 25% down. The rest of the country, meaning 49 other states, go from 5% down. And if they go through a limited review, they only have to put 10% down. So that's called geo-targeted. So Florida is geo-targeted and is the only state that has a higher down payment requirement for condos. We feel that this is unfair, and we've done significant advocacy to change that. It's not a bill, it's a guideline change. So we've gathered a good group of not only congressmen in Washington, but also local state politicians that have written letters for us to FHFA Director Bill Pulte in order to make that change. We feel it's unfair, and with the affordability crisis that we have in Florida and how many condos we have in Florida, making this one change would do more for affordability than, in many cases, a lot of the stuff that's being pushed in Tallahassee. So we feel that this is something that we're going to double down, continue to work on, because we feel that this is a change that should happen, and it should happen this year.
Do you know how common the condo is in Florida, like regarding all other property types? Is it like more than 50% of our property types? Do you think it is?
No, it's bigger than other states, but it's not. It doesn't reach 50%. We still mostly single family residences and townhouses and condos. as it goes down, it's less and less. So it's more single family, but it's still a bigger portion of our mix than other
states.
Yeah,
because usually when I get calls and I say, well, excluding Florida, they go, it's in Florida.
Yeah, it's in
And
Florida.
I go, okay, I'm so sorry, but that's the one state, it's all other states excluding Florida regarding LTV. And so I was just curious regarding.
Well, we've been talking about this issue. We've gone to Washington, D.C. To push for this because it is a national issue. FHFA is the one that mandates or oversees the GSEs, and it is a GSC change that would have to happen in order for that. And we feel that we have the momentum, and I wouldn't be surprised if that's something that we're able to pass this year.
Very cool. You mentioned it maybe turning a little bit into a buyer's market and possibly being able to leverage some seller concessions from, our sellers. Do you see closing costs as a big issue right now in affordability? And any tips you can give us to kind of minimize those closing costs?
I think that closing costs are pretty standard. They're not any higher today than they were before. But when you mentioned the buyer's market, when you reach a buyer's market, you have some flexibility in saying, okay, I will buy this house because there's less people in the market right now and to buy because the interest rates are so high. So when you do have a buyer wanting to buy your property, and if they could say, hey, we'll buy it, but we need you to help me pay some of the closing costs. I think that's usually the fastest way of handling it and the easiest way. And you're going to see, we've already seen this year a lot more contracts coming into our office that have seller contributions. And then there was a period of 3-4 years where we saw almost none. In fact, we saw people paying above sales price. That's not happening anymore today.
I just purchased my house in December. We got 3% seller concession as well. They needed to sell it as quick as possible. And then they actually rented from us from another 2 weeks because they wanted to stay in their home for Christmas. We were like, we don't want to move during Christmas anyway. So we actually made them pay rent for the following 2 weeks after we closed.
Yeah.
Like almost
Post
like
occupancy agreement.
Yep. So it worked out. In our advantage, pretty much everything. And we did a FHA loan.
Yeah, so, and you're not seeing, you're seeing them now. You just weren't seeing seller contributions for a few years as much, at least in the office. I always say my office is a barometer of what's going on because we get a mix of A paper, which I still call it A paper, but is conventional business, FHA business, non-QM and private lending, where we're seeing. So when we see one side of that in my office, one side of that go down, then it usually trends in the market overall. But what we're seeing more than anything right now is we're starting to see some seller contributions, and we're seeing the growth of non-QM market. The non-QM markets really started to come in around, I would say 2013, 2014 is when we started to see these bank statement programs pop up, and most loan originators were still doing only Fannie Mae and Freddie Mac and FHA. And occasionally they would do a bank statement program. It would be a smaller percentage of their product mix. Now today, it's a bigger portion of them. More loan officers are doing DSCR programs, bank statement programs, P&L, asset depletion. All these were used to be niche products now are a major part of the product mix for loan officers. And that is thanks to the non-QM lenders like A&D, who've come into the market and expanded on these products and found that these products are very well underwritten. The average credit scores on these are in the 700s. They are not defaulting any more than conventional business, and they were able to be packaged and sold, securitized, and that with players like A&D, that market has grown, and that private capital world is going to continue to grow. I see the trend of continuing less reliance on the government products, because in some cases, a bank statement, for example, somebody buying a primary home with bank statement, the par rate on that is at par with conventional rates. So it's not that it's going to cost you more. In some cases, it does cost you more to do a non-QM loan, but it's not crazy like it was before. There isn't a big delta between conventional and non-QM loans. So today, I think that's going to continue to grow, and private capital is going to take a bigger portion of the mortgage market.
And let's kind of flip a little bit to speed. We're seeing technology, AI being incorporated with many lenders, including ourselves, with income calculators, AI guidelines assistant. What's your take on technology? Do you think it's helping our industry?
I think so. I think that we are just at the beginning stages of where this is going. The unfortunate part is that there will be some positions that will no longer be needed. AI in itself is continuing to help with processing, with back office work, origination, marketing. At some point, that's all going to translate into faster mortgages, and in turn, cheaper, because the margins or the cost to operate for lenders, originators, businesses will decrease because of the use of AI, and eventually that savings will pass on to the consumer. So we see that we're just at the tip of that, and I see more of that coming in as we realize the power of AI and what it can do, and we're just starting to see what's happening. Every different lender I see has some sort of iteration of AI that's coming out, and where that heads and how that all gets helps the market is yet to be determined, but it is the future. You asked me this question a year from now, I'll probably have a different answer, because you're going to see a huge difference year over year.
The brain is a powerful thing, and you try and think in the future, and sometimes it's almost hard to imagine where you could be when you think about 20 years, where we were 20 years ago in technology. I mean,
Yeah.
I was very little then, but I still remember, logging on to my dad's huge computer with all the little startup things, the thing at the bottom, the desktop, I guess you would call it. And the screen was probably this thick. It would dial up, it would ring. And, now here we are. Within a second, ChatGPT will give you an answer.
When I first started in the industry, we had handwritten 1003s. So we'd take applications in our hands, and then we would put the package together, and we would FedEx it to the underwriter, whoever the underwriter was. So we had, as a business owner, I used to have huge FedEx bills, because we used to be able to send, and then conditions, if there were smaller conditions, we'd fax conditions over to the underwriter. So we've come a long way from, especially seeing the growth in a lot of the CRMs that today will reach out to your customers, say happy birthday, happy loan anniversary, or your rate is now, you could save $200, $300 now if you refinance. So all those things that you would have to do normally on your own now are being done automatically. I usually get a text, thank you, because I wish somebody happy birthday that I actually didn't wish happy birthday, but my CRM went ahead and said happy birthday for me. So those are the kind of things that have changed. I've seen a massive growth, and like I said, I've been 27 years in the industry, so I've seen a lot of changes, not only from the beginning, but also pre and post the boom bust cycle of 2008.
And to finish us off, thank you so much, by the way, for all of this great advice and giving us kind of an insight into FAMP. Can you give our brokers, our partners, one piece of advice to really help their clients get affordable housing and advocate for them?
If you are working a certain area, you really need to know your area. I think I always tell new loan officers, get in the car and drive the area and get to know who's selling what also, because if you align yourself with local real estate agents that know the area well, you can build a rapport with them. But know the area, know what your county and your city's offering in terms of down payment assistance, second mortgages that they may offer. Get to know what Fannie Mae, Freddie Mac offers. Get to know what your non-QM lenders are offering. A lot of times they'll have some down payment assistance programs, or they may have some sort of program for less down payment. Being able to learn those things and be able to communicate that to not only the realtors, but to your end user, to your customer, is important. That's what sets you apart. I think another thing that just overall general advice that I would give to new loan officers is, don't get stuck behind the computer. Don't think that if you just do a lot of social media that's you're in and that you can accomplish anything. Social media should be something that enhances what you do, boots on the ground wise. So if you are meeting people and constantly, giving out your card, giving out your information, and then they'll go and check you out and see that you do have a social media presence. It will help to say, okay, this person is very well entrenched in the industry. But if all you're doing is sending out stuff on social media and putting out posts, but not actually going and meeting people face to face, you're not going to be wholly successful. I'm not saying you can't succeed. It's not the avenue towards success. The avenue towards success is still in this industry, meeting people face to face, going to events, networking, going also to events like FAMP. We have events that are statewide. We have in Miami, we have Broward, we have the Gold Coast region, we have Fort Myers, we have Sarasota, we have Tampa, Orlando, Jacksonville, Tallahassee. There's events that are happening statewide that you get to network with other mortgage professionals, and then you get to learn. You talk about war stories. Oh my God, I had a problem with this file. Can you believe it? Oh, did you try this? Did you do this? Why don't you call this lender? Oh, they have a program for this. The more you spend time with your industry, the better you're going to become at doing your job. And like me, I'm a lifer in this industry. If you want to become a lifer in this industry, which is a great industry, it puts food on my table. But on top of that, this is the one industry that gives you that satisfaction of seeing a family that has been renting for X amount of years, and you get them into a home and they get into their first home. That feeling never gets old, really, when they thank you so much. Just yesterday, I had a client send me a bottle of my favorite wine, which is Bordeaux from the French region, and I was so happy because he was so happy that he got his home, that never gets old, and that's one of the beauties to help people reach the American dream. We do that. And this is what our industry does. And that's why I'm going to continue to stay in this industry, because it actually helps people reach the American dream. So I would say to loan officers that are out there, don't get stuck behind a computer, and don't get stuck behind social media. That just adds to what you do. You got to have boots on the ground. It's still that old school mentality of getting origination still applies today, enhanced by social media.
Thank you again, Orlando. We all appreciate you being here today, and I look forward to having you again.
Thank you very much.
Orlando, thank you so much for joining us and sharing your insights on how we can all work toward making homeownership more accessible. Now I want to hear from our viewers. What do you think is the biggest barrier to affordability? Is it rates, home prices, or a lack of support programs? Drop your answer in the comments below. And don't forget to subscribe for more expert conversations and actionable insights. Until next time, take care, stay informed, and let's continue growing together.